This is the Bank of Uganda's monetary policy statement for June 2021. The Bank of Uganda, at the Monetary Policy Committee meeting of June 2021, has decided to reduce the central bank rate, CBR, by 0.5 percentage points to 6.5%. The Monetary Policy Committee noted that economic developments have been broadly in line with the outlook of the April Monetary Policy Report. High-frequency indicators of economic activity indicate that the momentum of economic activity for the quarter to May 2021 was moderate. Indeed, the Uganda Bureau of Statistics, UBOS, in its June 2021 real GDP estimates indicate economic growth of 3.3% in financial year 2021, slightly higher than initial projections of 3.1%, owing primarily to stronger household consumption. However, contraction in the private sector investment is persisting, partly reflecting heightened COVID-19 induced uncertainties. Real GDP growth outlook remains unchanged at 4 to 4.5% in fiscal 21-22. Nonetheless, the recovery is expected to strengthen with above-trend economic growth in the outer years as vaccine effectiveness increases, which should allow relaxing the current public health measures and a stronger rebound in domestic demand. A high degree of uncertainty surrounds the economic outlook, with many possible upside and downside risks. On the upside, moderate growth in domestic demand is expected over the forecast horizon, and the strengthening global recovery is generally expected to be supportive of economic growth. Moreover, the vaccination process is expected to gather steam in the coming months, which should help to normalize economic activity quickly. On the downside, however, the main risk is a resurgence of the COVID-19 pandemic and conceivably more contagious variants. In the near term, that is 12 months ahead, domestic demand could be dented by still emerging second COVID-19 wave, especially in the sectors that are contact intensive. In addition, there is little space for a fiscal stimulus package to respond to the fragile economic growth, and the rising public debt necessitates fiscal consolidation to keep public debt on a firm downward path. Furthermore, a sizable share of domestic debt held by non-resident investors makes the domestic financial market an important transmitter of external economic shocks in the event of intensified global financial volatility. Additionally, the private sector credit growth slackened in March and April 2021, and in the months ahead, the growth of private sector credit could be unduly deterred by higher non-performing loans as forbearable periods come to an end and the real impact of COVID-19 pandemic on businesses and individuals becomes clearer. If these developments were to materialize, they would substantially slow economic recovery. Inflation remains subdued. UBOS rebased and reweighted the consumer price index basket in 2016 stroke 17 from 2009 stroke 10. The rebased CPI resulted in inflation being lower than earlier outturns. With the rebased CPI, annual headline and core inflation averaged 2.7% and 3.7% respectively in the 12 months to March 2021, lower by 1.2 and 1.6 percentage points compared to inflation based on the CBI, which was rebased to 2009 stroke 10. The new rebased CPI indicates that annual headline edged lower to 1.9% in May 2021 from 2.1% in April 2021, in part due to a decrease in the food crop, energy, fuel and utilities prices. However, annual core inflation rose slightly, 3.1% from 2.9%, primarily due to increases in the price for services. While inflation will remain below 5% target in near term, as excess capacity continues to exert downward pressure, it is forecast to stabilize around 5% target by the end of 2022. Going forward, the inflation path is likely to be shaped by uncertainties impinging on the upside and the downside. On the upside, if the upward surge of international commodity prices becomes another commodity super cycle, it will pose upside risks to the inflation outlook. This, compounded with a more depreciated exchange rate, one-off effects of increases in some taxes, adverse weather-related shocks, and a more robust than anticipated global economic recovery could put considerable upward pressure on domestic inflation. On the downside, a projected bumper harvest in 2021 could keep food prices low. In addition, renewed lockdown to combat rising COVID-19 infections and lower than anticipated domestic demand could exert downward pressure on domestic inflation. Nevertheless, the balance of risks is currently assessed to be balanced. The Monetary Policy Committee assessed that the risks to the economic growth outlook are still on the downside, that there remains considerable excess capacity in the economy, there is sectoral unevenness of economic recovery, and also a weak level of business environment. Therefore, The economic recovery continues to require monetary policy support until economic slack is absorbed, so that the 5% inflation target is sustainably achieved. Against this backdrop, the Monetary Policy Committee decided to reduce the CBR to 6.5% and maintain the band on the CBR at plus or minus 2 percentage points on the CBR. The margin on the rediscount rate and the bank rate has been kept unchanged at 3 and 4 percentage points on the CBR respectively. Consequently, the rediscount rate and the bank rate have been reduced to 9.5% and 10.5% respectively. This monetary policy statement has been signed by the Governor of the Bank of Uganda, Emmanuel TUMUSIIME-MUTEBILE, on June 16, 2021.